Hello everyone, I hope so you will be fine. So today we are going to discuss topic number 8.4. Again it is so this topic 8.4 is from corporate finance section and it is relevant to the exchange rates. Okay, so we are going to continue the exchange rate. So here we go guys, we are discussing today exchange rates, factors and risk mitigation. So today I will focus on that like which factors can affect the exchange rate. So this is what we will discuss today, and we will discuss like overall first five factors in out of which you can say three factors are related to the trade and two factors are related to the financial side. Okay, financial factors. So then I will also discuss about some theories. We got interest rate parity theory, we got purchasing power parity theory, we got international Fisher effect. So here we go. So first we are discussing factors affecting exchange rate. So my simple question is that why do exchange rate fluctuates? Okay, like what are the reasons for changing the exchange rate? So guys, we can divide this reason into broadly two categories. So first reason, we can say it's a there are certain factors which are related to the trade. Okay, and there are certain factors which are related to the financial sides. Okay, so trade related factors we have three. So first we got relative inflation rate. Sometime inflation rates may affect your exchange rate. And then second trade related factor is relative income level. Sometime income level of one country obviously can affect the exchange rate. Like if you are earning more or less, or if your income is high or low, so this can also affect the exchange rate. And then third, what we got a government intervention. So these are also trade related factors. Under financial factors, we got relative interest rate. Sometime due to interest rates, exchange rate can obviously can vary. And then we got here ease of capital flow. So here we go. I'm going to start first theory, which is the first trade related factor, which is relative inflation rate. So here we go. So guys, before moving to this text, what is written here? So let me give you first simple example to understand this mechanism, like how inflation can affect the exchange rate. So let's assume you are into a international store, for example, and you are trying to buy certain goods, for example, and because you are into international store, okay, and I'm assuming here that these goods are priced into different currencies. For example, it is written, let's say we got a price tag there. Okay. In the price tag, it's written that the price of this shirt, let's assume, or this goods, for example, in dirham, AED is how much? 100 dirham. And it's also written if you are paying in dollar, for example, it's written USD dollar, for example, $20. Okay, this is what is written. So it's written in other currencies as well. So I'm assuming here, so you are having dirham in your pocket. Okay, you are having dirham in your pocket. So this is what I'm going to write it here. So we got dirham in our pocket. Okay, and we also got spot rate, conversion rate, current rate. Current rate is, I'm just assuming hypothetically. Okay, so for example, spot rate is $1 equals, for example, 4 AED. Okay, and we got what? Dirham in our pocket. Now here you have, maybe you will think this way, that if you will buy this commodity or this product, so maybe in dirham you will pay 100 dirham, right? But if you will buy in dollar, let's assume if you will buy in dollar, maybe in dollar price it's $20. It means to get the $20, if the rate is, if $1 equals 4 dirham, so you can convert this $20 into dirham, right? So to get the $20, we will pay 4 dirham for each dollar. It means it will cost you 80 dirham, right? If you will convert, try to understand what I'm saying. So simply, like, now it means maybe you will think this way, it is better for you to buy this product into dollar, because if Even although you have a dirham in your pocket, but if you will pay straight away dirham, then it is 100. But if you will convert the dirham into dollar, so you will pay 80 dirham to get $20, right? Now what do you think, what is beneficial for us? Obviously are beneficial for you. So obviously it is more beneficial if you will buy in dollar, because even if you are buying in dollar, so but it will cost you only 80 dirham, right? But if straight away you are paying in dirham, it will cost you 100. Now please remember guys, as I told you, you got dirham in your pocket, right? Dirham. So what you will do? So you will sell dirham, okay? For what? To buy dollar. And how many dollars you want to buy? $20. And obviously, if you will multiply with the 4, it means 80 dirham you would sell to buy $20. And you what you will do? You will buy this shirt in USD, right? Because you feel that if you will buy in USD, it is more economical for you, it is more cheaper for you, right? Now think now, if this is your attitude now, because you are going to buy dollar, right? It means what will happen? So you are selling dirham to buy a dollar because you feel the price in dollar it is more economical. So now guys, what will happen here? Dirham supply will increase. Supply. The reason, because everyone, if let's assume if there are 1,000 customers are there, everyone will start selling the dirham, right? Because they want to convert the dirham into dollar and then they want to buy this product in dollar. So obviously, once you will start selling dirham, dirham supply will increase. And on the other hand, look what will happen. The demand for dollar will increase. Okay, so demand for dollar will increase, and automatically the currency which will be in demand, so that currency will get stronger. Okay, and the currency who is which is in supply, so that will get obviously weaker. So obviously once everyone will try to buy the dollar from the market, automatically demand and supply of the currency will obviously will fluctuate, and it will fluctuate your exchange rate also, right? So this is what is a quite common example, that how inflation can affect the exchange rate. Now I'm just moving to the just this side. Okay, so here we go, what is written in the text, because this idea I will use to explain this text now. So guys, look at here. So this is what we got a graph here. For example, assume you are living in India. Okay, you are living in India and your local currency is INR. Okay, local currency is INR. So here we got a graph. For example, if you will look this side, vertical side, it's written here price of 1 unit of foreign currency in terms of domestic currency. So I can just change this figure. I can write it as 50. Okay, so you are living in India and your local currency is in INR. Okay, now please remember here. So this we got it here, equilibrium point. Equilibrium point is what? This is your demand curve and this is your supply curve. Okay, and this is the point. So where demand curve cross the supply curve, and this point is called equilibrium point. We know in economics, right? So equilibrium point means say where your supply of the currency will be equal to the demand of the currency. Okay, the supply of the currency will be equal to the demand, so that point is called equilibrium point. For example, at equilibrium point, so what was the price? $1, it was equal to 50 INR, 50 rupees, 50 Indian rupees. Okay, here what's written here? Price vertically, what's written? Price of 1 unit of the foreign currency in terms of domestic currency. It means these are domestic currency units, you can say Indian rupees. Okay, and this was your equilibrium price, and this is your equilibrium quantity. For example, this is your equilibrium quantity. Equilibrium quantity means say what? Obviously here this quantity is for what? Quantity of the foreign currency. Like here the demand and supply of the foreign currency will equate, and at this point, which is your equilibrium point, so the rate is what? $1 equals 50 rupees. Now think this way, to buy $1, how much Indian rupees you are paying? 50 rupees. Now see what happened now. Okay, because I'm just trying to explain first graph and then I'll take you to the text. Now please remember this demand curve. This is the actually original demand curve. If it will move to this side, it means we would say demand is decreasing. And if this demand curve, like this line, if it will move to this side, we will say demand is increasing. Okay, demand is increasing. And this supply curve, look at this supply curve now. Okay, this supply curve. If it will move to this side, for example, maybe here. So we will say the supply is decreasing. If it will move to this side, we will say supply is increasing. Okay. Now, this is what is the idea. So now I'm going to explain the text. So need concentration here. It's really important. So please don't forget at equilibrium, our at previous equilibrium point. So what was happening? So $1 was equal to 50 Indian rupees. So assume this is 50 and assume this is 40. So this I'll explain later. But assume $1 was equal to 50. Now look what happened. And where you are living in India. So now I'm going to explain the text and I'll tell you how the lines will move around this graph. So here we go. So now guys, starting point is so you are living in India and the today spot rate are at equilibrium point $1 is equal to what? 50 Indian rupees. Okay, now what? So please remember here, for example, and I'm also adding information here. You are, for example, importing because you are living in India. Okay, don't forget. So you are importing goods from USA. You are importing goods from USA. This is what the trade you are doing. Okay, this is what the trade you are doing. So you are importing goods from the USA. Okay, now what happened? Now in USA, what happened? There is a inflation now. So what will happen automatically? If in the USA there is a inflation, automatically the prices of the US goods will increase, right? The price of the US goods will increase. It means the US goods will become more expensive for Indian people, right? Because the prices are increasing in USA. And if you are importing goods, and now the same goods will become more expensive for you. Okay, so this we understood now. First line. So when the rate of inflation in the given country, I am assuming in the USA, if it will rise, so relative to the rates of other country, I am assuming we are living in India. Like if simply the rate of inflation in the USA, if it is higher than the rate of inflation in the India, okay. So the demand for that country currency will fall. Which country currency? US dollar. The demand for US dollar will fall. Why? Because due to this inflation US goods will become more expensive for you. So that is why you won't you don't want to buy at high price, right? You don't want to buy. Okay, now due to this trend what will happen next? So that because demand of US dollar will fall. Why? Because you will stop importing the goods because those goods are more expensive. Now second point, once obviously you will stop buying the US goods, it means you don't need to buy US dollar also because you are not importing goods from the US. Now second thing, so it means the demand for US dollar, now demand for US dollar will reduce. So if the demand will reduce, so please remember, so the this inward shift of the demand curve result from the lowered desirability of that currency because you don't want dollar. Due to that, dollar demand will decrease, and that is why this demand curve will shift to the to this side. If it will, like if it was here, this is demand curve, so it will automatically shift to this side. Obviously if demand curve will shift to left side, so it means demand is decreasing. So this is the second point. Okay, second point is also clear because US dollar demand will fall. So due to that, demand curve will shift to the to the left side. Okay, now what happened? For example, if there are other peoples who are also in India, obviously they were also importing goods previously from the USA, and they got some dollar with them because they were importing goods. Now what they will do? Automatically, those investors who are living in India, other investors, they will unload this currency. Which currency? Dollar. Because they don't want, because US goods are becoming more expensive, and if they hold some dollar, so they don't want these dollar anymore. So what they will do? They will sell these dollars in the market. Those other investors will sell dollars in the market. Due to that, again dollar supply will increase. So what happened in the first previous in this section? I told you dollar demand will decrease. And then I told you other investors who hold some dollars, they will unload this currency. They will sell this dollar into the market. Due to that, supply of dollar will increase. right? Due to that, what supply of dollar will increase. If the supply of dollar will increase, so please remember supply curve will move to this side now. From here, this was the original supply curve. It will move to this side. New supply curve will be there. Okay. Obviously, if it will move to this side, it means supply is increasing. If it will move to this side, it means supply is decreasing. So that is why this is the next point. So obviously, the investors who are other investors in India, if they have dollar, they will unload this currency because they don't want these dollar anymore, because dollars products are more expensive now due to inflation. So there is more of it available, reflected an outward shift of the supply curve. So supply curve will move to this side. Okay. Obviously, if new demand curve will be there and if new supply curve will be there, so there will be a new equilibrium point. Okay. Now please remember here one more point here, because supply of where I was writing, I told you there, supply of dollar will increase and demand of dollar will decrease. So due to that, what happened? Previously, if you were paying previously at previous equilibrium point, if you were paying 50 Indian rupees to buy $1. Now, what will happen at the new equilibrium point? Maybe because dollar demand is not there. So previously you were paying 50 rupees to buy $1. Maybe now due to less demand of dollar, maybe you can get the same dollar by paying 45 or 40 Indian rupees. So due to this result, due to this inflation, now what happened? Actually, dollar got weakened here and Indian rupees got stronger, because previously you were paying 50 rupees to get $1 and now you would pay only 40 rupees to pay $1. It means Indian currency will appreciate and dollar will depreciate. Right? This is what they are saying that. So the again new equilibrium point will be here, right? New equilibrium point. You can see here. This is the new equilibrium point where the new demand curve and supply curve will cross each other. So this will be the new equilibrium point. And here you can see here it's written 40 Indian rupees will be equal to $1. Understood? So this is what is the graph. So in simple words, I can summarize now. So I can summarize now the country. This is the general statement which will help you to solve question. General statement is that the country with high inflation, the country with higher inflation, okay, is always subject to depreciation of its currency. Subject to depreciation of its currency. Okay. For example, here in US inflation was there, USA currency will depreciate. If in India inflation will be more, obviously an Indian currency will depreciate. But in my example, we zoomed in where we are buying goods from USA and there is more inflation. So US dollar will depreciate. Understood? So please remember, and here I told you so many things. So let me show you now questions I will show you. Don't worry at that. So 4 to 5 points you have to remember overall. Okay, whenever there is inflation in one country, its currency will depreciate. Okay, and because that country's product will become expensive, so we don't need that currency anymore. So their demand will decrease, their supply will increase. Okay, new equilibrium point will be there, and the country in which we have high inflation, that will be subject to depreciation of its currency. Understood? I hope so it is clear. So this is the first trade related factor. How, why it is trade related factor? Because the price of the goods are, changing the exchange rate. Now here guys, we have another theory. Please remember here, again, I'm assuming this is another factor which is called relative income level. Sometimes income level, for example, in India, I'm just giving you example here. For example, in India, if your income level is high, like you are earning good salaries, okay, if your income level is high, so high income means, please try to understand the relation. High income means what? It means if you have a high incomes, it obviously it means you will look for new consumption opportunities, right? Because your income is high. Now maybe you will look for what? Or you will say, okay, well, let's explore the world. Maybe you will go in different countries. For example, maybe you are going to Switzerland. Let's assume. Mostly, for example, if let's assume we will visit Switzerland, all Indian peoples, obviously, because if their income is good, so they will visit other countries, right? Now in India, what will happen? Think this way, please. You have to think. So what will happen? Because you want to visit Switzerland now, right? If you want to visit Switzerland, so obviously you need Switzerland currency, and but you have Indian rupees. So what will happen now? So you will sell Indian rupees. to buy Switzerland currency. And now see in your India itself, what happened? Everyone or most of the people are selling Indian rupees and they want Switzerland currency. So automatically Switzerland currency will be in demand. Switzerland currency will be in demand. So demand will increase. Right? If demand will increase, automatically exchange rate will change. And automatically what will happen? Automatically what will happen? Because Switzerland, for the currency of the Switzerland, there is more demand, right? There is more demand. If demand is more, obviously then the Switzerland currency will get appreciate. And obviously if that currency is getting appreciate, then Indian rupees will get depreciate. Because if one currency is appreciating, other should depreciate. So this is what is the point here. They're saying that citizen with the higher income citizens with the higher incomes look for new consumption opportunities in other countries. Maybe you want to explore or maybe you want to invest. So diving up the demands for those currency means the foreign currencies. And obviously, so diving up the demand for those currencies, foreign currencies demand will increase and shifting the demand curve to the right. Do you remember I told you? So demand curve, if this is your original demand curve, which is downward sloping, this is your supply curve, and this is your, for example, original equilibrium point. Now what will happen? So demand will increase because this is the demand curve. So it will move to this side now. Demand of the currency will increase and new equilibrium point will be there. Previously, for example, I'm just giving example, maybe to buy 1 unit of Switzerland currency, I believe it's Swiss franc. Okay, to buy 1 unit of Switzerland currency, previously, for example, you were paying 70 Indian rupees because now everyone want to buy Swiss franc. So again, to buy 1 unit of Swiss franc, so maybe you will pay 80. So obviously, what will happen because this currency is in demand, now you would pay more of your currency to buy the unit of foreign currency. So that is why what will happen, new equilibrium point will be there, which will be slightly higher than old equilibrium point. Okay, so you can assume this is, for example, if you will assume, if I'll keep my figures here, for example, previously it was 70 rate, 70 Indian rupees, now it will become 80 Indian rupees. So this is the new equilibrium point, 80. Okay, and please remember here demand curve will shift to this side, to the right side. So whenever they would say demand curve is shifting towards the right, it means demand is increasing. Please don't forget. If demand curve, this is demand curve. If it is shifting to right side, okay, shifting to the right, it means demand is increasing. It means demand is increasing. If it is shifting to the left, it means demand is decreasing. And whenever demand will increase, any currency for which demand will increase, that currency will appreciate. And any currency for which demand will decrease, that currency will depreciate. General statements. Okay. I hope it is also clear. And now we got third point. Please remember here, I know these things are difficult to absorb, even it is difficult, these things are difficult to explain as well. So now we got third trade related factor, which is government intervention. Okay, sometimes government will intervene, okay, in the forex markets, and due to the government intervention, so the exchange rate will fluctuate. So I can give you example here. Here we go. Let's have a look here. So government intervention affects exchange rates. We know, if you remember from the last lecture, I told you also in the previous lectures, sometime while I was explaining exchange rate systems, I told you sometime government will buy or sell foreign currencies to just adjust the exchange rate, right? So it means government, through government intervention, exchange rate can also fluctuate. So here we go, but here I want to add some extra information. Government intervention affects exchange rates through trade related factors by influencing the relative value of the currency to boost export or to reduce imports or to correct trade imbalance. So these three words you have to understand. Like why government is intervening to boost export or to reduce imports or to correct the trade balance. I'll explain these things. Please remember here. So guys, for example, first of all, China, I'm giving you example for China. And this example is for to boost export. That if you want to increase your exports, so what we have to do? Actually, we should devalue our currency. Devalue means we should depreciate our currency. Why? What will be the effect? Like, it's very famous example, China. China intentionally they are trying to devalue their currency. Okay, why? Because if they will devalue their currency, for example, if you got Chinese yuan is there, right? If you got $1 and you were getting, for example, 2 yuan against $1, I'm just giving you example. Okay, now what? 2 yuan. Okay, now depreciation means what? If you will sell $1, you can get 20 yuan. So this is depreciation. Like rate has moved from 2 to 20. Okay, now guys, please, why China is devaluing? Because if foreign investors, like if you're living in USA, obviously you would think, oh, you will spend only $1,000, maybe you can get 1 million Chinese yuan, and you can buy lot of goods from China by spending this 1 million yuan. So definitely you will go for it, right or wrong? So actually when we devalue, or when we depreciate our own currency, so this is the effect. So our products, means a Chinese product will become more cheaper due to the depreciation of Chinese currency. Chinese product will become more cheaper, will it become more economical or cheaper. Okay, for whom? For foreign investors, for other investors, for foreign investors. Understood? Because due to devaluing, so they will bring their small amount of currency and it will become a huge currency in China. Okay, so this is what is the point here. So I have already explained here. So how you can boost export, for if you want to increase your export, so it is better to depreciate your currency. But if you want to reduce export, obviously no one want this. If you want to reduce export, then what is better? Appreciate your currency, because once you will appreciate your currency, so your product will become more expensive for the foreign investors and they will not buy. Understood? Now I'm going to give you another example: reduce imports. Guys, please remember here, if this is general statement, please remember here, I'm going to explain now reducing imports. For example, here example is what? Oil importing countries. For example, let's assume any country, we can take for example Pakistan. So let's assume Pakistan is importing oil. Now, if $1 equals 200 Pakistani rupees, and if there is another situation, because oil prices are quoted in dollar, right? Let's assume this is the rate: $1 equals to 200 rupees. And what if $1 will become 1 rupees? Assume, just assume hypothetically. So it means the imports will become more cheaper for you if your currency appreciates, if rupees appreciates. So obviously previously to buy $1 you are spending 200 rupees, and now you to buy $1 you will spend only 1 rupees. It means it will automatically, when you appreciate, so what will happen? There are two facts are there. When you appreciate your local currency like Pakistani rupees, if you will appreciate it, the first effect is what? Import import will, for you, this will be the impact here. Okay, so this will be the impact. So a stronger currency, because if your rupees will be appreciated, a stronger currency increases the purchasing power of domestic currency consumers for foreign goods, because you can just buy $1 by spending 1 rupees, and you can import the goods also. This is the first effect. If you will appreciate the country, right? If you will appreciate your own currency, so what will happen? So it will increase the purchasing power of domestic consumer like Pakistani consumer for the foreign goods. Understood? And on the other, I hope it is clear, right? So this is what is you can remember so far this point. So next point I'll try to explain the question, otherwise it will be complicated. So what I told you first, reducing import, like if you want to reduce the import cost, like if you want to simply reduce the cost of import, so you have to appreciate your currency. And I told you, if you want to increase your exports, so then you should depreciate the currency. So this is what 2 points I told you, okay? And there I quoted a Chinese example. And now third, we have what? Correcting trade imbalance. What is trade imbalance? Please remember here. So every country is calculating, trade balance. How? This is what is the formula we apply generally. The formula is we always take what? Exports. For example, if you are living in India, so what they will do? So they will take exports of the country, exports minus what? Imports. For example, against obviously exports, we will get receipts, right? Inflow. And against imports, we have to make payments. So whenever, so this is what is called if the, now please remember, if exports are greater than imports, so it is called trade surplus. Why? Because exports means the receipts are more than payments. It's called trade surplus. And if the scenario is if exports are less than imports or imports are greater than exports, so this is called what? Trade deficit. This is called trade deficit. Okay, now Japanese example I'm going to give you. So if you want to remove trade surplus, how you can remove? Obviously, if you will reduce the exports. Okay. And if you want to remove trade deficit, then you have to increase the import, right? Generally, what you can do. Okay. So I can say other way around also. If you want to remove the trade surplus, so you can either decrease the export or increase the import, right? It's the same thing. So this is what, but I'm saying from one side only. If you want to remove the trade surplus, what we have to do? We have to reduce the exports. Okay. If I want to remove, and if I want to remove trade deficit, I have to increase the imports. And do you remember? I told you for exports previously, I told you point. I told you for the export, because this point I'm hitting now. I told you if you want to increase export, it is better depreciate our own currency, depreciate the local currency. This is what I told you. And now what you can do other way around. If you want to reduce the export, again export, but you want to reduce now. So what you have to do? You have to appreciate the currency, your currency. If you will appreciate your currency, so this trade surplus can be adjusted, can be removed. Okay, so this is what is written here. So trade, if I want to remove trade surplus, look at here. This point is explained here. If I want to remove trade surplus, so what I have to do? I have to reduce exports. For that, I have to I have to appreciate my local currency, okay, being a country. So this is what they're saying for the trade surplus, appreciating the currency. This is what I told you, right? Now, other way around, here for the trade surplus, appreciating the currency can slow export growth and encourage imports, reducing surplus pressures. So surplus can be removed. And now other way around, a second equation I'm explaining. What if you want to remove trade deficit? Mostly this is what countries want. They don't want trade deficit actually. Okay, and they want to remove this trade deficit. How you can remove the trade deficit? Either by increasing the import. Okay, so no, if you trade deficit is what? So when your exports are less than import, this is your trade deficit, right? If I want to remove this trade deficit, so what I can do here, tell me. If I want to remove the trade deficit, so what I can do, I can explain from this point of view. So if I want to remove the trade deficit, so I have to increase the export. Okay, I'm just hitting the export here. Here I also hated the export. Here also I'm hitting the export now. So if I want to remove the trade deficit, so I have to increase the export. And how I can increase the export? I told you already. If you want to increase the exports, so then it is better you should depreciate your local currency. So these 2 points you should remember actually. Okay. When you appreciate your local currency, exports will go down and this will remove trade deficit. Sorry, trade surplus. This is what trade surplus. Okay. Because to remove the trade surplus, I have to reduce my exports. Okay. If I want to reduce my exports, so then I have to appreciate my currency. And if I want to remove deficit, trade deficit, how I can remove? If I will increase my exports. And to increase the exports, I need to depreciate my currency. Okay. So please remember these 2 points. So I hope it is clear, right? Don't mix it. Let me write clearly if you are confused. So I can just write it here, just as a short summary. So you can remember these points there. For example, if imports are greater than, sorry, exports, let me write first because I'm focusing on exports. So if exports are greater than imports, okay, so this is called what? Trade surplus. And if I want to remove this trade surplus, so what I have to do? If I want to remove the trade surplus, so I have to decrease the export. And if I want to decrease the export, so I have to appreciate the local currency. Okay? Because if I'll appreciate the local currency, obviously my product will become more expensive for the foreign peoples. And second scenario, if my if now what is trade deficit? I'm telling you, when your exports are less than imports. So this is called what? Trade deficit. Okay. And trade deficit what? If I want to remove trade deficit, it means I have to increase the export. And if I want to increase the export, so what I have to do? I have to depreciate the local currency. This is what you can remember here. Okay, guys. So this is how government can intervene. So they can manage their exports, okay, and their local currencies, and obviously if their exchange rate will change. This is what is the third factor. So I have already explained three factors now. Okay, this is what is called correcting trade imbalances. Okay, like how you can remove trade surplus or trade deficit. This is what is done by Japanese government actually. Okay, and to export the to boost the export, Chinese is devaluing their currency. So this I told you already. Okay, and if you want to, this is what to boost the export, and if you want to just if you want to reduce the import cost, you have to appreciate the currency. This is just additional point you can remember. Okay, I gave you oil importing countries example. I hope so, guys. It will not become mess up for you. So these are three trade related factors. Now I'm going to explain financial factors. It's quite easy. Don't worry. Financial factor is what? So just you have to think logically here. For example, again, I'm giving you example. Let's assume you are living in India, and in India, interest rates are, for example, 5%. 5% means say if you will invest, you can earn 5%. Now what you got? You got another option, USA. If you will invest in USA, so their interest rates are 10%. Tell me, do you want to earn 5% or 10% as an investor? Definitely you would say, I want to earn 10%. But you are living in India and you have Indian rupees, and but you want to earn 10%, which is in dollars. So what you will do? Now you will sell Indian rupees, to buy dollar. Why you want to buy dollar? Because you want to invest in dollar, and you want to earn 10% return. So now by this activity, what will happen? Think logically. You are selling Indian rupees to buy dollar. So dollar demand will increase. If dollar demand will increase, so obviously dollar will appreciate also. Dollar demand is increasing, so dollar will appreciate also. So this is what is the simple point. Like those country, as per this relative interest rates, okay, as per this relative interest rate factor, those country, first I'm saying what, listen me carefully. I'm saying that those country which are having high interest rate, their currency will appreciate because people want to invest into that country and they want that currency. That's the reason. But after some time, I'll say another theory, which is interest rate parity theory. That is quite opposite. Okay, understood? I hope so it is clear. Now, guys, if you will look at here, this is what I have already explained here. Now, it's a just simple version I have written here for all this theory. So, if you will just look at this graph, now I'm going to explain the graph. For example, this was your original equilibrium point where 50 Indian rupees were equal to $1. Now what happened? In USA, interest rates are higher. Now everyone want to buy dollar because they want to earn high interest rate. So what will happen? Dollar demand will increase and dollar will appreciate as well. So it means now what? Previously, if you were paying 50 Indian rupees to buy $1, because now dollar has appreciated. Now maybe you would pay 60 Indian rupees to buy $1, right? So that is why the new equilibrium point will, what will happen? So a new equilibrium point will be little bit above the old equilibrium point here. This is the new. because due to this dollar demand will increase because it's moving towards right side and towards this side. Okay, the supply curve will move to this side and the new equilibrium point will be there. Okay, and automatically dollar will appreciate also. Previously if you were paying 50 Indian rupees to buy $1, now you would pay maybe 60 Indian rupees to buy $1. Okay guys, I hope so it is clear. So now we got another thing here, ease of capital flow. This is actually the most important point here also. For example, I'm just giving you another example. Let's assume if in USA, you are living again in India. For example, if in the USA, let's assume, okay? I always quote Indian examples because most of the students are from India. So, for example, if you're living in India and now in USA, what happened? For example, interest rates are higher. Just assume this way. Okay, interest rates are higher. It means we want to invest in dollar, right? We want to invest in dollar. And obviously to invest in dollar, we will buy dollar. If you will buy dollar, dollar demand will increase, right? And now another point is what? If US government, they will they will relax their policies. For example, they can say, okay, if the US government would say, bring your money, invest in the USA, earn the profit, and you can take the money, there is no restrictions like UAE government. We don't have a restrictions. For example, you can send money, right? If you can justify your income, you can send money to your home country, right? There is no limit for that. So now the question is, if USA will also relax its remittance or capital movement restrictions, obviously people would happily invest in USA, right? Because income is already higher, interest rate is already higher, you got opportunity to earn high interest rate, plus there is no restrictions, so obviously people will invest. So obviously then what will happen? So USA dollar will get stronger and stronger. Okay, understood? So this is what they're saying, that they're saying if a country with high interest rates loosen restrictions. Okay, interest rates are high and there is no restrictions also against the cross border movement of capital. If there is no restriction by US government, the demand for the currency will rise, dollar demand will rise as investors seeks high return. And look at this point, this factor means the ease of capital flow, like if there are no restrictions, has become by far the most important of five factors listed. Whatever we studied above factors, guys, it is the most important from them. Okay, because nowadays ease of capital flow is there, we can transfer the funds electronically on a single click, millions of dollar and millions of rupees we can transfer from one country to the other country, right? So now guys, here I'm going to show you summary now. If you will look at here, we got it here, exchange rate determinants. I told you determination, how exchange rates, how do exchange rate fluctuates actually. So we got three trade related factors and two financial factors. Trade related factors were relative inflation rate, relative income levels, and government intervention. Actually, these factors will affect the demand and supply of the goods or services. And due to demand and supply of the goods and services, the demand and supply of the currency will change, because obviously to buy the goods or to sell the goods we need currencies, right? So the due to the demand of the goods, demand for and supply of currency will change, and due to that exchange rate will fluctuate. And here we got second leg now, financial factors. We got two, relative interest rates and ease of capital flow, right? So actually due to these two factors, demand for securities, means say investments will change. If demand for investments or securities will change, okay, like bonds, stocks, so it will automatically affect the demand for and supply of currency, and again due to that exchange rate will change. So I'm going to show you question now, guys. Okay, so guys, we got a here question here. They're saying that a shift of a demand curve, do you remember the graph? Let's look for the graph. I'm showing you this graph here. This is relative income level. Okay, Curie. Actually that question is relevant to this, that's why I'm showing you this graph. And what do you remember what I told you? For example, I give you example, those countries which will have high income level, so their people will look for new consumption opportunities, and obviously they want to go here and there, maybe abroad also. Okay, due to that, income is in India is higher, for example. So what they will do, they want to explore other country, for example Singapore. So it means they want Singapore currencies now. Okay, they want Singapore currency because they want to go there to explore the Singapore, right? So if they want Singapore currency, so they will, so Singapore currency will be in demand and that will get stronger. This is what I told you, right? See, income in India has increased, but foreign currency has appreciated, like Singapore dollar. So this is what you have to remember. And I told you, demand, whenever demand will increase for the foreign currency, so demand curve will move to the right side. If it is moving to the left side, that means demand is decreasing. Okay, but if it will move to the right side, it means demand is increasing. So now we have to go through here. This is right side. Okay, if you move this side from here to this point. Okay, now let's have a look to the question. They're saying a shift of the demand curve for the country currency to the right. I told you, whenever, if this is demand curve, if this is demand curve, if this one, okay, if this demand curve will move to this side, it means demand is increasing. Now you have demand of foreign currency is increasing. Okay, now the question is why it can happen. So this thing, shift of the demand curve for the country's currency to the right could be caused by which of the following? Like, what is the possible reason why demand of foreign currency is increasing? Number one, a fall in country's interest rate. Okay, if that country currency interest rate will decrease, so demand should decrease, not increase. So this is not the option. As I give you example, if USA will reduce the interest rate, no one will invest. But if USA will increase the interest rate, everyone will invest there. Right? So it means US dollar demand will be there. So this is incorrect. So fall in interest rate mean to say decrease in demand, not increase. So but here demand has increased in the question. So this is not the option. Number two, why demand has increased? Second option, a rise in consumer income in the other country. It is correct. A rise in the consumer income in another country. Yes, if other countries people income will increase, so they want to maybe come to your country now. So they want your country, they want your currency, okay, to come here. Obviously, the demand of your currency will increase. And if the demand of your currency will increase, obviously, because your currency is foreign for other people, right? This is what it's written, a rise in consumer income in another country. It means your currency will become foreign for that country, right? So if the demand, if the income in another country will increase, so demand for foreign currency will increase. If demand for foreign currency will increase, so demand curve will move to this side. And it is correct answer. Look at the next. Domestic inflation worsen. Like if domestic inflation, please remember, like it means here inflation in the local country is more. Inflation in, for example, in local currency is more. It means the products in your country is more expensive than foreign products. So obviously, if this is a scenario, so you would prefer to buy foreign goods. And if you would prefer to buy foreign goods, so the demand for foreign currency will increase and demand curve will move to this side. But why this is not the correct? So the domestic inflation worsen means say inflation has increased in your, look at here, inflation has its domestic inflation worsen. So here we have explanation for that. C point. As a country's inflation rate rises, when your country rates will increase, its currency loses purchasing power and investors move their capital elsewhere, driving demand curve for the country's currency down, not increase actually. Because in any country, don't think in on your country, think any country where inflation is more. So those think this way. This is the more logical way to explain, I think so. Think this way. Any country in which inflation is high, any country, it's not only your country, any country in which inflation is high. So it means their product will become more expensive for others. And other people, they don't want to buy because because due to inflation, products are more expensive and you don't want to buy expensive products. If you don't want to buy expensive products, you don't need that currency then, right? Obviously demand will go down, not will increase. Demand will go down. This is what is the correct explanation of this. So demand should go down due to this factor, not increase. Then a foreign government placing restrictions. If you will place restrictions, if you will increase the restrictions, no one will invest into that country, so demand will go down. But if you will remove the restrictions, remove, so everyone want to invest there, so demand will increase. Now you have to read this point. A foreign government placing restrictions means that they are imposing restriction. This is the scenario. So demand should go down. If it is going down, it should move to the left side, not to the right side. But in the question, they're saying it has moved to the right side. So that is why this is not the correct option. Only B is the correct option. Okay, guys. So we got it here now. Another question. Okay, please, here we go. They are saying that the accompanying graph, this is the graph, depicts the supply of and demand for US dollars. Supply and demand for US dollar in terms of euros at a point in time. And here it's written important statement. Euro is the domestic currency. Okay, for example, you are living in Europe now, and there you are living in Europe, and euro is your local currency, and dollar is your foreign currency. Okay, they're saying currently equilibrium exchange rate is $1 equals to 0.65 euro. Okay, the spot rate or current rate is $1 equals $1 equals what? 0.65 euro. Can you interpret this? It means if you want to buy $1, you have to give 0.65 euro to buy $1. Okay. If inflation of the dollar exceeds that of euro, they're saying that if here inflation is high and here in this country inflation is low. So I told you general rule for inflation, general rule, if you remember, I told you the country in which inflation will be higher, that currency will depreciate. It means dollar will depreciate, right? Because inflation is higher in the dollar. And in euro, inflation is less. So it means euro will appreciate. Euro will appreciate. Okay, this is the outcome now. Dollar should depreciate and euro should appreciate. Okay, now how it would appreciate? Previously, if you were paying 6.5 euro to get $1, now rate should be like that. You should get the same $1, but by paying less euro. Like let's assume 0.60 euro. Just assuming. Because in this, if you will compare these two rates now, this rate and this rate. So if you will compare these two rates, and in this rate, dollar has appreciated and euro has appreciated and dollar has depreciated. Why? Because previously you were paying 0.65 euro to get $1, and now you are giving only 0.06 euro. Okay, only 60. Previously 65. Now you are giving only 60 euro and getting $1. It means euro has appreciated. So now what? They're saying the new equilibrium exchange rate. New equilibrium exchange rate would most likely settle at. Where new equilibrium? Like if this is the equilibrium exchange rate here. $1 equal to 65 euro. For example, $1 equal to 65 euro. Okay, so new equilibrium should be lower to this, right? Should be lower to 65 as I gave you example, because in that scenario, euro is appreciating. It should be lower than 65. This should be the answer now. So here we go. If you look at the option now, here you got option of quantity, option of price. For the price, one thing is for sure, price should be lower than 65. Now, any price, it could be 61, 62, 60. Okay, but we have to look at the option. But quantity we don't know, because equilibrium quantity, supply and demand of the foreign currency, where it will be equal, that is equilibrium quantity. We cannot say anything about equilibrium quantity, because equilibrium quantity could be higher or lower than this point. But the rate definitely will go down because euro will appreciate. So one thing is decided, that rate will go down, but we cannot say anything about equilibrium quantity, because equilibrium quantity means where demand and supply will be equated. Maybe this point could be higher or lower than existing point. We cannot say anything. So that is why quantity is always indeterminate. We cannot determine. But the price for sure it will be less than 65, less than 0.65, because here it was 0.65 equilibrium. Now new price will be less than this, less than 0.65. So it means if you look at your options, where option is, which options are less than 0.65? One option is this one and one is this one. Not this one, not this one. So these two can remove. It means new equilibrium price, for sure it would be 0.60 less, because 0.60, 0.60. Quantity is higher than QE. No, we cannot say about the quantity, equilibrium quantity, because equilibrium quantity is indeterminable. We cannot determine. It is indeterminate. We cannot determine it. Okay. So it is indeterminate. Okay. You cannot determine it. The quantity. Quantity could be higher or lower than equilibrium, but price definitely will be lower. So this is the correct option A. Okay. We got another question. Can you look at here? They're saying that if a central bank of a country raises interest rates, okay, if a central bank of a country raises interest rates sharply. So do you remember interest rate? I told you previously, I told you the country which will increase the interest rates, obviously people want to invest into that country, right? Because they want to earn more return. And if they want to invest into that country, so they need that country's currency. For example, if US will increase the interest rate, so people want dollars to invest here. So dollars demand will increase. Right? So here we go. If dollar demand will increase, it means dollar will appreciate. So now here we go. If central bank of country raises interest rates sharply, the country's currency will likely appreciate, obviously. So decrease sharply in value, no, it will not decrease. Remains unchanged, no. Decrease in relative value, no. Increase in relative value, yes, it will increase in value, right? It will appreciate actually. Right or wrong? This is the D is the correct option. Okay, guys. I hope so it is clear. I know, guys, it is very technical. So please do let me know, is that clear?